All right, all right. Here we go.
Looks like we're going. Well, welcome everybody to the Happy Homebuyer class. This is the virtual version of what we do in person at local pubs and breweries. So excited to have you with us here tonight. And if you're catching this recording at a later date, glad you found us here online. I got with me Dan Keller here, one of the top 1% mortgage loan originators in the entire country. Really great loan officer, somebody that I refer many clients to every year, and you're always providing a great experience for our clients. And I think a lot of it's around this education that you bring and a value that you bring, Dan. So really just want to say thank you for that. I'm really excited to be here tonight with you.
Yes, I'm super excited too. We've been working with first-time homebuyers, you and I both. This is going on year 7, I would say, about year 7. And you and I share a lot in common with, we have a heart and a passion for educating and for creating content. I was one of the first, I would go as far as saying the first mortgage person in the mortgage industry to get on YouTube. And you can verify that. It's been fact checked actually, because I said this on a podcast one time and they actually fact checked me and they're like, holy crap, October of 2008. And that was the year that I got into mortgage. And so I just knew that I was, as a former college professor, needed to get information out there because I noticed right away real estate agents and mortgage people were not educating their clients on how to, but even more advanced stuff that you're going to learn tonight. So I know you do the same thing. You're one of the top YouTubers in the real estate space here in Seattle, which is awesome. And I know you shared a really fun stat with me last year. I mean, what percentage of your clients came from YouTube? It was a lot.
We had 9 people buy and sell, just from reaching out on YouTube. So I think we definitely share that same thing. But we helped 46 people buy and sell houses last year. So lots of people getting into houses and moving on to the next house for them. So just really excited to be here with you.
Yeah, which is why we're here tonight. So what we're gonna do tonight, no pressure. I'm just gonna fake like we're actually live in the Lunchbox Lab or LA Bay Brewery. No pressure. Like, we're not here to pitch you on anything. We wanted to give a quick intro to just kind of let you guys know, where our hearts are and why we do this. Like, why are we here tonight? It's because this is what we do. We create content, we teach, we educate, and we would love to, if we provide enough value and you feel that it's a good fit and a good connection, when it comes time, I'd love to be your mortgage guy. And I know Zach would love to be your real estate agent. Ultimately, that's the goal. But hey, sometimes we know that your sister sells real estate. And so I'm your mortgage guy, but your sister's your realtor, or the vice versa. But either way, you guys, we're here. Our hope tonight is to provide a ton of value. And but what I'm going to do is just kind of kick it off like we normally do, like we're live. It's just kind of, we start with the fundamentals, the basics. So I'm going to go ahead and get this. Let me just crank this up.
Get the slides up there on the screen.
At least see our faces at the very beginning, and then we're going to spend the majority of the rest of the evening kind of in the sidebar off to the side. So why don't you, Zach? I'm going to have you kind of just take it away. We already just introduced you and I, so why don't you take it away and we'll go from there.
So tonight's agenda here, real quick, we're going to talk about the mortgage process and mortgage rates. We're going to talk about how to buy a house, and then talk about the market a little bit. And then we're going to share something for us that's been really, really powerful for us, just a basic tool on accumulating wealth, not only in your home purchase, getting you into debt, right, but also helping you get out of debt and establish wealth for the long term. And then there's a few fun things to share. But as we jump in, we just want to spend a couple minutes here for you to consider what the next year, what the next 5 years looks like, because as we start to think about a home purchase, it's a big decision. And I know for Dan and I, we both every year look through and think about what our 1-year goals look like and what are our 5-year goals look like, and we write those down. So wherever you're at, just take a minute, and we're going to pause and allow you to do that, but just take a minute and think through, what's the dream scenario in a year? Does it involve owning a house? Does it not? And what does that look like? So take that minute here real quick, and then we'll pick back up. About 30 more
I think
seconds,
this
guys.
exercise is so valuable. And I know
Oh, yeah.
Zach and I talk about this all the time because we both have done it, you know, both in our careers. And then, you know, as an educator looking back, I wish someone, when I was buying my first house, had me kind of plan out what my 5-year, my 3-year outlook looked like. Because oftentimes, why do you want to buy a home? I mean, I talk to people all the time, like, why are you here tonight? Like, why do you want to buy a home? And then if you could draw out your ideal financial scenario, and a home being the center of that, we'll talk about that later on, how would you want that to look? So there's a reason, a rhyme to this reason. And I think you're going to see this by the end of the evening, but putting stuff in writing is so important.
Yeah. So let's talk about mortgage stuff, Dan. Why don't you kick us off? You know, a lot of people really want to know, how do I get a loan? What's the process look like? How do I get the best rate? And I think you're going to tell us some of that stuff right now.
I love it. It's my favorite topic. It's what I do. So I keep it super simple. And it doesn't matter if you work with a private mortgage, local mortgage professional like myself, or a banker or credit union. They're going to evaluate 4 main things. Number 1 is credit. Okay. Your credit score, your debt, and what is on that credit report. Okay. So your credit history. And it's so important. And I'll go into more detail on the 5 factors that impact your credit score. But really, you've got to have a credit score, and then you've got to show the lender. Really, I call it a character score. Okay. Because what your credit score is and what your credit report shows a lender is your likelihood for coming true or staying true to your promise to repay us debt. We're going to loan you $700,000. What are the chances of you not being able to repay us? And a lot of lenders look at your credit report and your credit score first to judge you on your ability to do that or not do that. So number 1 is credit. Number 2 is cash. This is your down payment and money that you have in reserves. Number 3, and this is where all of the issues normally land at banks and credit unions and mortgage companies, when loan officers, mortgage professionals mess up, it normally comes from this. Number 3, income and employment, miscalculating income and misjudging employment, how that person is paid. Bonuses, commissions, hourly and salary, whether you're able to use a second job, whether you're able to use 2 forms of income, whether you're able to use commissions or bonus income. All right. And then number 4 is the property type. Now, number 4 really has nothing to do with your pre-approval, but up front, if you know, for example, that you're going to be purchasing a condo, okay, there's a different underwriting process for condominiums than single family homes. There's things that you need to know as a home buyer buying a condo that you don't need to know buying a single family home. So that's why I put number 4. It's overlooked. But the 3 main, credit, cash, and income and employment, are so important for you to understand. And what we do differently than other mortgage companies and banks and credit unions is I make sure that you are fully underwritten, approved for credit, cash, and income and employment up front. Meaning most banks and credit unions, and Zach can verify this because he's worked with other mortgage professionals. He doesn't do every deal he closes is not with me. I mean, you have listings.
I wish.
You don't even know who the mortgage lender is going to be on your listing sometimes, right? But you can attest that when you do have issues that pertain to financing, most of the time it comes down to, the lender just didn't do a thorough investigation into income and employment, and they didn't verify the income and employment, how that person was paid and how much, whether it be through tax returns or verifications of employment. What we do, we verify everything up front, and we have it underwritten, approved up front before you actually even go out and start shopping for a home. And so that's super
huge,
important
Dan.
to understand up front.
So tell us how to get the best rate, because this is the other thing everybody wants to know.
It's the number one question out the gate that I get from people is, how do I get the best rate? And I tell people, there's one, working with a local mortgage professional like ourselves is important because you're going to get accurate information, not just information published on their website. Number 2, what I do with every single one of my clients is I'm transparent. I want you to go to Mortgage News Daily. And the reason why I like Mortgage News Daily, that's this one right here in the middle. Mortgage News Daily does an average. They do a survey, okay, of the top mortgage companies in America and what they're publishing their interest rates at. All right. Now, what I do on top of that is I do an internal search through Optimal Blue. And this is all of the loans that have been locked to date this month from the top 300 lenders in America. So Mortgage News Daily is presenting mortgage rates that lenders are advertising, the top lenders are advertising, okay? What Optimal Blue, the one on the left, does is it shows actual locked rates, current locked rates. So you can see there's a little bit of difference, 4.7 versus 4.6. Now, again, I'm using this as an example because this was from our April class that we did, all right? And so the difference is very, 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 very small, but this one over here is more accurate because it's locked rates versus advertised rates. But anyways, nonetheless, they're comparing the top 300 lenders in America. So if I give you a rate quote, you're going to find that it's going to be between probably 4.5% and 4.8%. And if that's the case, then that means you're getting a good rate. I try to tell people don't, and you'll say the same thing, I'm sure too, Zach. The internet, websites, you can publish anything nowadays. What's most important is what you can actually get. And by working with a local professional, one that's in the marketplace, we're not going to mislead you because we're going to be held accountable. If I mislead you with a low rate that you can't get, you're going to go complain to your realtor like Zach and be like, dude, your lender is way off. He told us we were going to get 4.5 and we ended up getting 4.8. That's not cool. Another place where you can go to learn about mortgage rates and kind of see a national survey is freddiemac.com. And then you just click on mortgage rates. One thing that I wanted to talk about right now, because it's the pink elephant in the room, is rates. They are climbing and they're climbing fast. So we went from 2.875 on a 30-year fixed in December and January to 5.5% right now in June. Crazy. It's the fastest increase of mortgage rates in the history of America. And so don't be fooled by that. We're going to talk a little bit more later on in the class about inflation and mortgage rates, recessions and mortgage rates. I believe in the next 6 to 14 months, you're going to see mortgage rates come back down for a brief period of time. So don't try to time the market. Don't time the market. Get in the market, get in the game. And when rates do come down in the next 6 to 12 months, that will present an opportunity for you to refinance. And that's a way to redo your mortgage and lower your interest rate. And I'm going to kind of wrap up this section on how do you get the best interest rate? Well, there's 4 ways to get the lowest interest rate. Number 1, a credit score over 740, a down payment greater than 20 to 25%. So the ideal down payment for the best interest rate out there would be 30% or greater. Most people are putting down less than that, but it's not the major factor. I'm going to ask a trivia question in a second to see if you guys can guess. Number 3 is type of property. So condo, manufactured home, single family home, a rental home, like an investment home. So type of property determines your interest rate. It has a big difference. It makes a big difference. And then number 4, you can pay discount points, meaning you can pay extra closing costs to lower your interest rate. And I'm going to give you an example of that here in a few minutes, but I'm going to throw this out there. You don't have to raise your hand. You don't have to unmute yourself, but which one of these 4 do you think plays the biggest role in getting the lowest rate? I'll give you about 3 or 4 seconds to figure that out.
Yeah, why don't you drop something in the chat if you have a thought about that?
Yeah. Number 1, credit score. Number 2, down payment. Number 3, type of property. Or number 4, paying additional closing costs to buy down your interest rate or to lower your interest rate. All right, it's a spoiler. Most people get this wrong. It's number 3, type of property. If you were to buy an investment home right now, your interest rate would be like 6.5%. It'd be crazy. If you buy an owner occupied home, it's only about 5.5, 5.3. And no other way with bad credit, increased down payment or paying discount points can you cause a spike of about 1% in interest rates. So number 3, type of property is the answer. That example on discount points, this is really why I wanted to close with this as my final slide. Let's jump to the middle section on points. All right. So imagine a pencil on a pendulum, and on one side you've got rate and on the other side you got fees. That's really the 2 things when you're looking at an interest rate, you can have a lower interest rate, but when you lower that interest rate, look at what it does on the other side of that pendulum, the eraser, the fees go up. So if you want lower closing costs or lower fees, your interest rate goes up. So that's a way of explaining discount points. You can pay additional closing costs to lower that interest rate. Sometimes it's worth it, sometimes it's not. I'm telling all of my clients right now, I'm advising against paying extra discount points if possible, because rates are going to drop here in the near future. And so there's no need to pay extra closing costs knowing that you're going to refinance to a lower rate in the near future. Another thing that people get hung up on and they get it confused with other types of insurance is private mortgage insurance. Private mortgage insurance is an insurance premium that you pay the mortgage lender if you're putting down less than 20%. That private mortgage insurance premium is depending on your credit score and down payment, is a small premium. It can be anywhere between $50 a month to $300 a month, but most of the time on a $700,000 loan with 740 credit score or higher, it's right around $150 to $175 a month. So not a whole lot. And yes, that does go away after 2 years, or if you pay down your principal balance so that there's a gap of 20%, meaning you have 20% or more equity. And then the last thing is homeowners insurance versus title insurance. So we said a lot of insurance stuff: private mortgage insurance, homeowners insurance, title insurance. So homeowners insurance is an insurance premium that you pay separate. It's included in your monthly payment that helps protect your home and you. So let's say you're at a party and you're just this crazy guy and you get a couple drinks in you and you like to, maybe sometimes get a little rowdy. You get rowdy and you get yourself in a fight, and that person sues you. And anyways, you get sued for whatever. Your homeowner's insurance policy can cover stuff that you do. It covers you, but it also covers your house. Okay. So if you're at your house and you have a party and someone throws a cigarette on your carpet and it lights your house on fire and you have to evacuate, your house burns down, your homeowner's insurance would actually cover that. Okay. So there's different aspects of homeowner's insurance. Let's say a house, a tree on your neighbor's property falls down and it falls through your house and destroys your house or destroys your roof. Your homeowner's insurance covers that. Okay. So there's three main types of insurance that people talk about. Now, title insurance protects you against outside claims against your property from like previous owners. Okay. It makes sure title insurance protects you so that when you buy a home, you're buying that home with clear title. You have to assume that even if you bought new construction, someone owned that property or that land before you. And so it protects you against any claims that could come up down the road against that property relative to the actual property or title. Actually, I surprised you guys. I have one other slide right here, and this is just real quickly on different down payments. People always ask at homebuyer classes, like, can you buy a house with 0 down? Yes, you can do that with a VA loan or a state bond loan. The next down payment, lowest down payment option is FHA. That's 3.5%. Normally we use FHA because it has a lot of fees that FHA HUD charges. Normally we use FHA with clients that have lower credit scores or they just don't have a whole lot of money to put down. So we use FHA to get them into the home, and then we typically refinance them out of that as soon as we can into a conventional loan, which is the next option, which is the most common loan in Seattle. It's about a 7% down. I think recent statistics showed that Seattle area home buyers are averaging about 7% down for their down payment. It used to be 5%, so it's gone up a little. And that's a loan that's backed conventional. That means it's backed by Fannie Mae and Freddie Mac. And then there's 10% down, very similar. And then you get into the 20% down, which we're seeing a lot of people that are selling homes that have a lot of money to put down. They're putting 20% down, or with a jumbo loan, which are loans with loan amounts greater than about $890,000. They require you to put down a little bit more money to offset the risk of defaulting, okay, on those bigger type loans, those bigger type properties. So that concludes the intro to mortgage section. I'm going to wait for about 30 seconds to see if any of you guys have questions on this before we move forward. But we always like to take this time too to let you all know about the strategy session. So Zach, why don't you explain what a strategy session is?
Let's get unmuted here. So the strategy session, everybody, is a more deep dive into your own situation. So we're looking over, Dan will do a look over income, assets, credit, and kind of help give you some loan options. And then I'll also go over some criteria, things with you. And really the point of that time is to focus more on you and less on how this whole process works for everybody, and dive into your own situation. So we'll bring it up again at the end, but if you get now a lot of value out of this and you want to have a conversation with us more one-on-one and ask more questions that pertain to your specific situation, we'll be able to have that information and bring some more value to you on an individual level.
I love it. Yeah, a lot comes out of that. I mean, very rarely do you get to sit down with a mortgage guy and a real estate guy and just make it all about you. Talk about you and your budget and your finances and real estate and your plans and all of that good stuff. So this is one of my favorite sections of the night because I always learn when you talk about this. So why don't you talk to us now that you've been pre-approved, now that you understand mortgage, you understand your budget, you understand what your down payment and your monthly payment looks like relative to buying a home. Why don't you talk to us about going out and actually buying a home in the Seattle area?
Yeah, so let's skip to the next slide here, Dan.
There we go.
With the road, there you go. So this is our road to buying a house. So steps to buying a house. And Dan already talked a little bit about the mortgage pre-approval, which I would consider step number 2 in the process, education being step number 1. So attending a home buyer class, I think, is a great way to start. Some people are reading blogs online. Maybe you're even watching YouTube videos of mine or of Dan's, but really just kind of starting to wrap your mind around what it is that you're going to be doing and getting yourself into. And then that mortgage pre-approval is key, as Dan's already kind of shared some of those reasons why that's important. I always tell people it's important for 2 reasons in the end. Number 1, it gives you an idea for what you can afford and what your budget is and how much it will cost on a monthly basis. But it also is something we provide to a seller when we're making an offer. So that pre-approval is going to be required if the seller is going to consider your offer. And some of the things Dan mentioned, like pre-underwritten approval, maybe being able to close a little bit faster. Those are some tactics for getting your offer accepted. And having that really strong approval is key for you as you're searching, but also in those negotiations. Step number 3 here for me is home search criteria and that buyer consultation. So we talk about the strategy session a little bit there in the middle. It's kind of a hybrid of a mortgage planning meeting and a buyer consultation. I'd say it's a watered down version of the 2 kind of put together. But that buyer consultation is where we really dive into the criteria at a high level. I have a lot of questions, kind of like if you're going to a doctor's office. And then we talk about the process itself, and you're getting that right now. So I would say that's one of the values of these home buyer classes, is you're getting to learn about the process. But I do weave that into those consultations for people that don't attend the home buying class and don't have that foundation. And then we go out and we really dive in with those criteria in mind at touring homes. So for me, we want to get that pre-approval done, and we want to have that criteria established so that when we're out looking at houses, number 1, we're looking at houses that we can afford and also meet what we're looking for, but we're also ready to take action when the time comes, because those houses are selling so fast. And even as the market's been shifting a little bit, and we'll talk about that here in this class, homes are still selling 6 to 10 days on the market. There are some sitting a little bit longer, but still the average house is selling extremely fast. So you want to have everything dialed in ahead of time. And those home tours, that's where we're out looking at houses together. I typically have clients see 3 to 5 at a time because there's just so much information, right? We want to prioritize those top houses so that we don't miss out. And those home tours are great. Those are private tours. Some people will go to open houses on the weekends and supplement a little bit. And they may also go to open houses even before attending a home buyer class. So you might be in that same boat, but those home tours are where we get to dialogue about the different houses and really get to, let's say, prove the home search criteria, right? Everybody has this idea of what they're looking for, but once you start to see it in person, that's where you get the real emotions involved in the process, and you start to see, well, maybe that's actually more important to me than I thought, or maybe that's not as important to me as I thought. But you get to know those locations and those types of houses a little bit better and more intimately. And then you got to make a decision, right? Then you got to negotiate an offer. You have to make an offer. And we'll talk a little bit about how to be competitive and successful in this market. But we are in what's called a seller's market, where sellers have a lot of that negotiating power, but we want to put our best foot forward if there's competition, and also protect you in the ways you want to be protected, and make the best offer for you as well. So again, we'll talk more about some of that stuff, and really I'll share some tactics in the next slide on how we can set ourselves apart in a competitive situation. But I've been in hundreds of these real estate negotiations, and every single one of them is different. And I think for me, with every client, we always talk through all of the weeds. So we'll talk, I have 2 different videos. One's 30 minutes about the offer process, and another 30-minute video on tactics of winning those multiple offer situations. So for me, a question that I get asked a lot is, how do I know if I found the right house? How do I know? And for me, you have your criteria, and then you also have that emotional feeling. So most people are buying a house, their first house, with the intent of living in it. So there is that emotional connection. And I liken it to maybe finding a spouse or partner. If you've been in that situation before, you have your ideal list maybe, or at least some idea in your mind, but then there's the actual emotional, like, can I see myself with this person? So sometimes I joke that the home buying process is really more like a dating relationship on your way to finding a spouse or partner. So it's a funny analogy, but I think I could show you how each of these steps kind of fit into that realm. And then after we're under contract and we have a negotiated offer, we're going to have this due diligence period where we go through lots of different things. But I'd say, the main parts of this due diligence period are going to be contingencies. So those are things in the contract that protect you. I call those butts in the contract. A contingency is an opportunity for you to back out if the worst case happens. So maybe if for some reason you don't qualify for financing anymore. I've never had that, Dan, with you, but I have seen that where I'm the listing agent and the buyer, provided a pre-approval letter, and the lender was like, oh, actually, I didn't even look through I didn't even verify everything. I didn't underwrite it. It was just a pre-qualification. So I've seen some situations where, it doesn't work out, or it might not have worked out if we did accept their offer. But that due diligence period is where we're finalizing the financing. If we're having an inspection, maybe afterwards, that's another common contingency, is an inspection contingency. And then we're also interacting with a lot of other parties. So we have title and escrow are involved here. These are some buzzwords in real estate. Title companies providing that insurance that Dan was talking about. And then the escrow company is like a third-party money manager, and they're making sure that we're getting all the I's dotted and the T's crossed, and the money's exchanging into the right hands, and we all close on time. So there's all these different moving parts. Dan, we've got an appraisal on your end with the lending side, but our job on the back end is to kind of manage that process and be like project managers and help get us to closing, which is our last step here. And that's I like to say, this is what we're all working for this whole time, getting you the keys. And before you get your keys, you have to make your final payment. After your loan's approved, the lender needs to make their payment, and then you also need to have what's called recording happen. So the county will archive the documents, and that's when you're officially the owner. And then we get to celebrate and have a good time, and you get to get some keys to your new house. So that's our quick overview here of the home buying process. There's a lot that goes into this, and we can dive more into that in a buyer consultation or strategy session as desired. But if anybody has any questions around this, if you want to drop them in the chat, we can kind of do some Q&A at the end as well.
Yeah, this is one of my favorite parts too, is we get to do a little kind of like trivia. Whoops, I meant to cover it up, but it looks like I exposed it.
Right.
But there's a lot of myths right now in the market, man, that with first-time home buyers that, and I hear it from the pre-approval side of it. When they come in and they're just like, gosh, there's so many people and there's so much cash in the market, and there's 55 offers on every house and 3 of them are cash. And I'm like, yeah, that's true. But is it really true? I know there's a lot more cash in the marketplace, which is healthy. I know it hurts first-time home buyers. So you and I did some research, and look what we found for this year in 2022. Yeah. I think this is crazy. 86%.
So in the last calendar year.
Yeah. I mean, 86% of people buying homes right now are needing financing. 14%
Yeah.
have cash. And so
Mhm.
what I like to say is your real competition are other people that are getting financing. So,
Mhm.
and I know you've built out, I love your program. You call it an A buyer?
Yeah. So for me, as I'm explaining this to people, the market has shifted a little bit. So I think there's some opportunities maybe for people that wouldn't consider themselves an A buyer as we talk through this. But for me, there's been so few houses on the market, and it's been so competitive for every single house, and it still is, as we'll talk about. But really, the only people that have been able to purchase houses here are A buyers. And for me, an A buyer is this: you've got that pre-underwritten mortgage approval. So you're essentially making an offer that feels like cash to the seller. And you can, go back, Dan. It's all on one here. So you're essentially making an offer that feels like cash to the seller, and it's not the same as cash. Cash is cash. But if there are alternatives, it's the best type of approval you can have on your loan, and you can close. Dan, you can do these in 10 days, right? Which
Yeah.
is similar to what a cash buyer is going to close in. So it definitely puts you in that competitive space, especially if you can beat the cash buyer on price a little bit. Favorable terms for the seller. So this is things like, how quickly can you close, or can you allow the seller to stay an extra month in the house after closing, right? So the seller can have a little bit of time to move out. Maybe you can provide a little bit more earnest money, which is your good faith deposit, typically 2 to 3%. In our market, we've been seeing 5% every day on these. So that's, again, an opportunity where you can set yourself apart on those terms. Removing contingencies, I mentioned those are the buts in the contract. Things like financing or inspection are kind of the two main contingencies. But if you find yourself in a competitive situation, those buyers are not only having the pre-underwritten approval or having cash, but they also have the favorable terms to the seller and the fewest contingencies. So maybe removing an inspection or doing an inspection ahead of time before making an offer. And Dan, I mean, you could speak to this, but there's been a lot of buyers saying, hey, can I just not have this financing contingency? What are my risks? Right. So I tell people that, you're risking your earnest money in the end. But Dan can help kind of walk through those scenarios, and he does with clients of like, what is the real worst case here? Are we going to be able to make this happen? And that's where that pre-underwritten approval really gives a lot of confidence on the financing side. And then ultimately, highest price wins. So in this situation, in this market, you really got to have the highest price. You got to have the fewest contingencies and the best terms and that pre-underwritten approval. So if you have all of those things, you're putting yourself in that A buyer category. So some people just are naturally more competitive and more have a higher risk tolerance.
Yep.
And those people have been more successful recently. I would say, as I've seen the last month or so, I think there's more opportunities for maybe a B buyer. And I would say that's a buyer who maybe does 3 of the 4. And I think there's some opportunities coming up. So I don't think the market's going to be uncompetitive here, but I do think there's going to be some more room for buyers that maybe don't consider themselves an A buyer as far as the risk tolerance, but maybe doing 2 or 3 of these things to be successful.
Yeah. And I think it's really important to know too, that, and you can confirm this, that highest price, that's why you put it forth on the list. Highest price isn't always the most important. If you can, you might have the highest price, maybe offering the most, but you're using a national lender and there's not a great pull-through ratio. There's actually it's 68% of all loans through big banks and credit unions kind of crash and burn. They have issues. And so agents, realtors know that. And so sometimes you might have a client that is working with a local lender, has waived their financing, can close in 12 days. And that's providing really great favorable terms for the seller, because the seller needs to get out, maybe go buy another home. They're going to go with that versus another one that might be $10,000 or $20,000 higher than
you got
that.
it.
So
you got it.
Yeah. So I love that you do put that down at the bottom. This is one of my favorite. I love investing. And this is you're talking my type of stuff here.
Yeah. Well, I mean, I love it too. And I think as we're looking at just buying a house, sometimes the cost is daunting and those monthly payments are daunting, especially as interest rates are a little bit higher than they have been. And again, more historically normal, right, Dan? I mean, interest rates aren't higher than they have been previously in the long run, right?
Yeah, exactly. Right now, it's not bad to have a partner or some help,
Yeah.
especially to offset the higher cost of home ownership.
So that's where some of these strategies help. So, you can have roommates, and we call this house hacking. It's more the slang term you hear maybe on the internet, but having roommates is a great way to offset the cost if you're purchasing on your own, maybe, or even maybe if you're a couple and you have an extra bedroom or two. I know in my house, we rent out our basement, and we treat it more like a roommate situation than a separate rental, because it's not technically an ADU or attached rental unit or detached unit. But in our situation, we've rented out the basement and we still rent it out. It's great, and we never have taken it over. We haven't really needed it. And it's a great, extra side income to offset the mortgage. I think the short-term rental situation is also an option for people. Again, it probably comes down to your situation and how much work you want to put into it and effort. And some houses maybe are better suited for that. But I've seen people rent a couch. I've seen people rent a bedroom. I've seen people rent a basement, or some kind of a detached structure. So there's lots of different ways to do that. I've even heard of people renting their backyard these days. It's like a sniff spot. I don't know if you've ever heard of that, Dan, but sniff spots, you can rent out your backyard for people to bring their dogs. And if you have a cool enough backyard, you can even have people camp in your backyard. So
that's cool.
Again, lots of ways to do this. And then I think the more traditional way is that the multifamily 2 to 4 unit property where you occupy one and rent out the other ones. There's just not a lot of multifamily properties out there. So, your most likely scenario is probably one of these other three, but you can get the traditional financing as long as you're owner occupied with one of those 2 to 4 unit type of properties. So just some other options to get the ideas flowing as far as like what your situation looks like. And I always tell people this before we transition. You always want to be able to make these payments on your own, right? You don't want to be in a situation where you can't afford the payments without the help, because in that situation where you don't have the help, you're stuck.
Yeah.
So assuming that you can make the payments, even if it's a stretch, then you can start to offset it with some of these other tactics.
I love it. And I think you talk to a lot of people, that are my age, that have been in the game a little. And I bought my first condo when I was 23 years of age. I did house hacking, and it was before house hacking was a trending word. I think deeper or bigger pockets podcast kind of made it a word. But yeah, I mean, I had a roommate for 3 years, paid half of my mortgage payment for me, and I didn't even realize that. I mean, at the time I'm like, oh, this is helpful. But in hindsight, it is a great hack to get into real estate and to pocket that money and reinvest it. And so just a heads up, we got about 15 minutes left. We're in the home stretch. Okay, we're in the home stretch, and this is where there's a lot of fear and concern right now in the market. And this is where Zach and I take data and we support the decision to purchase a home, or at least we give you information that could support your decision to buy a home. Every person's scenario is uniquely different. That's why we do suggest the strategy session. But I look at the media nowadays as data versus drama. Trust the data through people like Zach and I, credible resources. The media is all about drama. All they talk about is drama. All they want is views and to create more talk around drama. I'm at the health club almost every single morning on the stair climber at 5 to 5:30 in the morning. All I see on the TV is news, and it's drama. It's negative. And half the time it's wrong. Whenever they post real estate stuff, I'm like, it's got this much truth. Like an inch of truth, but so much, it's just wrong. You could have spun it the other way. And so why don't you talk to us about real estate right now and just some statistics. And this is what I love about this section of the night.
Yeah. So let's talk about the market. And then I think I talk about the market on my YouTube channel every month, Dan, as you know, and I do market updates on a monthly basis. So if you want to see that, that's something you could follow along. But I pulled some more recent data too, so you can kind of see March's stats, but also what they look like right now. So last month, as of the end of May here, Bellevue's median sales price, $1,850,000, which is up 15% year over year. And Seattle was $995,500, so just under $1 million there. So you'll see Bellevue kind of had a spike there, and there's some higher end properties that probably sold that month, pulling that median up. But even if you just look, aside from that jump up to the 2.25, Bellevue's prices have been hovering kind of around that 1.8, 1.9 million here the past few months. So prices are at or near all-time highs in Bellevue and Seattle, and really across King and Snohomish County. Both of them are right there hovering, but they have plateaued over the past couple months. So last month, Seattle and Bellevue had pretty much the same prices as they do right now. And then if we look at this next slide, and again, this one has as of March 2022. So I'm going to share the most recent numbers with you, just again for comparison. I think this.
Yeah, we do this for a
out.
reason, so you can compare recent months' movement too. Yeah.
Yep. So you get to kind of see how the market's been shifting, right? We talked about how the market is shifting a little bit. So a healthy real estate market's going to be in that 3.5 to 6 months of supply, where there's a little bit more balance between a buyer and a seller, having a little bit more negotiating power. And we have the Snohomish and the King County data up here. So Snohomish County is going to be right around a month right now. So Snohomish County residential supply, 1.2 months of supply last month. So we've seen that number jump up a little bit. And if we're looking at King County, we're going to be right around a month as well. So we're seeing the numbers come up, but again, we're still super, super low inventory, which just means we're in what's called a seller's market. And that means that in those negotiations we're talking about, sellers have all that negotiating power. And if we're looking at this graph, we did pop up where it was a little bit closer to a healthier market for buyers and sellers back between spring 2018 and the spring 2019 there. And then we've just seen that we've seen the inventory numbers keep going down since then. So we still find ourselves in a very competitive market, but I would say there's a little bit more opportunity for buyers out there right now. And this translates over to the average percentage of the list price. So people are hearing and seeing the headlines about how much over asking price houses are selling. And these numbers are real. Earlier in the year, it was crazy. Especially in Bellevue and on the east side, I was hearing and seeing and experiencing 30%, 40% over asking price. Again, this is an average. So that just means that not every house is doing this, but this is the average. And if we're to look at averages in Seattle and in Bellevue last month, as of May 2022, we are seeing 10% in both over asking price with the average.
So down just a little, but not a lot.
Down a little bit, but not a lot. And what that really means is just that some houses are sitting on the market a little bit and doing price reductions. And what happens around this time of year every year is that sellers start to push the price on their properties, trying to get what their neighbors sold for and not wanting to list low and kind of cross their fingers and hope for the best. And so that's where you start to see the prices drop a little bit and a little bit less of the over asking price and more days on the market because sellers are not wanting to sell their house for $200,000 less than the neighbors sold for, but not every buyer is willing to pay that premium. So we got to kind of find where the market's at. And that's what happens every time around this time.
Well, let me ask you this. So all of that data that you just shared about Seattle and Bellevue, King County versus Snohomish County real estate, any of that data suggests that we are heading toward a bubble or in a housing bubble or toward a collapse?
I think what the data is suggesting to me, and I watch this on a weekly basis, is that we're seeing more houses coming on the market than we are seeing going off the market. So more new houses versus pending. So we are seeing and continuing to trend towards more supply. So to me, that means that we're going to see a little less of the crazy over asking price type of offers with 40% over. I haven't seen that in a while. It's been more in that 10 to 20% range, which is still a lot, but a little less of the crazy. So I would say that I think what we're going to see and what the data is suggesting to me is that we might see something like a 2018 to 19 where the prices were a little bit more stagnant. And if you look at those 2 years between 18 to 20, if you go back, Dan, to the price, the first one, you'll see between like 18 and 2020, prices pretty much stayed the same. And the graphs kind of zoomed in. So it's not as pronounced, but prices in Snohomish and King County were almost flat for 2 years.
And if you do the same thing right here with inventory, you saw very, very similar markets between like end of about 18, middle part of 18 to the early part of 22. So it's and look at these stats, almost, you saw this one kind of come down in regards to list price. We didn't really have these massive, percent over list.
Now we haven't had anything like this. So that's where it is. It's like, we're still, what we're seeing in 17 and 18, Dan, is what we're experiencing right now. And I think people are like, oh my gosh, there's so much more inventory and the market's correcting. But we haven't even corrected to the craziness that we had when Seattle was the hottest real estate market in the whole country. So I think we're probably overreacting at this point, but I'm just projecting forward that we might have a little bit of a slowdown as far as the train's not going to be continuing to run off the tracks. But I don't think we're in any kind of a bubble. And this is why, I mean, if we look at some of these slides, Dan, I think these are great. Foreclosure activities at an all-time low. I think in the last couple of years, we've had built in there the COVID stuff a little bit. But still, we're not anywhere near the type of foreclosures we were seeing in 2006, in 7, 8. I mean, that's kind of crazy stuff. And I think a lot of that's because we have better borrowers, right? And that's, our next slide here. Credit scores are way better. So that's one of the big things that changed is we had better borrowers and a lot more regulations. You could speak to this, Dan, but there's so many more regulations now. And credit score is just one of them, but really helping make sure that we have better people in the houses as far as their abilities to pay and their financial history. So I think that really helps stave off some of those foreclosures. We also have, and this isn't even on here, record high equity in houses, right? So we have all-time high in equity, which means, as house prices change, those fluctuations are less of a hindrance to people. And I think this is huge. We have the largest generation of home buyers coming into the market, the millennials, at the same time that we're coming out of or trying to come out of one of our worst periods of construction in recent memory. And a lot of that, Dan, is because of the crash in 2008 to 12. Banks weren't lending money. But if we flip over to the next slide, look at how many houses, 21.4 million, 20.2 million, 25, 25, 26, 27. This is by decade. And then look at the last decade.
Shortage.
Hardly kept up with the 1930s population growth. And we've had the largest generation of home buyers, not even to mention all the older millennials, right, that have already been buying houses. But now we have all the younger millennials buying houses, and we haven't been able to keep up. So we've been seeing the population continue to increase, but we haven't been building houses. And that's not a problem that just solves itself overnight. So we've had 10 plus years of not building enough houses, and then we've had the largest generation of buyers in the market too. So are we seeing anything like what we saw back in 2008 to 12? The answer is no. Now we might have different problems and different issues, and we do, but if we're looking at the data and the numbers, it doesn't suggest that we're in any kind of a bubble. I think right now we're experiencing fear in the market because of some of the things that have happened in the past, and also higher interest rates. But fear isn't predicting what's going to happen in the future. That's where the data is important, right? Tactical decisions versus emotional decisions, and the same thing holds true. So this is some of the people, and Dan, this is your slide, but I think just some of the main people, right, talking about the market. You've got Zillow on here, Freddie Mac, you've got CoreLogic, which is a great company for real estate data, National Association of Realtors. They're all projecting just slower growth, right? I talked about maybe flatline growth. That's probably more pessimistic than what everybody else is saying. But I try to be realistic, and they're trying to be realistic too. But this is across the country, and we find ourselves in one of the hotter markets in the country. But still, even if we just have more normal growth or even nothing, for a few years, that might be maybe the worst case scenario.
Well, they're saying here that if you took the average of all of these, we're still going to have about 6% nationally. And then we've got local economists saying that we will be most likely in the 8 to 12% for the next couple of years, which is still really good appreciation. It's really good. A lot more healthy,
That's really good, but more sustainable. Still a lot. If you think about it, it's still a lot of money every year for people, especially if they're trying to buy their first house. So that's just more normal. And Dan, tell us about this, because I think this is huge too.
Well, I think this is really important that people understand that there's fear right now in the market. One, and that's why I showed you this previous slide, is that if I buy a house right now, is it going to go down in value? Well, what if it does go down in value? One of the things I ask all of my clients is that can you commit to living in the house that you're buying for the next 3 to 5 years? If the answer is yes, because we all need a place to live. If the answer is yes, you have nothing to worry about. Let's say the house goes down in value or only appreciates for 2.7% for the next 2 years. By the time you look at the tax benefits for homeownership, the IRS refunds, the fact that every single month you're paying down what you owe, and then you get moderate appreciation, you're still going to come out the other side in a positive financial situation. But let's look at this. What does housing do during recessions? And what you can see is that these dark blue lines are recessionary periods. Homes went up in value. They went up in value in the 90s. They went up in value. 2000 recession went up in value. This is the collapse. So we tend to eliminate that because that was due to housing. That was due to fraud and housing. But look what happened right after that recession, up in value. 2020 recession, and we've gone up in value since. So I think it's important to understand that. And then here is proof that I believe that mortgage rates will come back down. Same thing. Recessions, rates go up. Recession happens, rate comes down. Rates go up, recession happens, rate go down. Mortgage rates go down. Recession happens, rates go down. Recessions happen, rates go down. Recession happened in 2020, rates went down. Rates are going back up. We are due for another recession here in the next 6 to 12 months, and rates will come down.
Yeah, and before we talk about the wealth accumulator here real quick, I mean, the government is trying to slow things down right now, right? Pumping the brakes. And we're seeing that in the stock market. And then historically, we're going to see a reflection in some way of that in the real estate space, right? But as we see, it's not equal, right? It's not the same. Stock market's way more volatile. And so when the stock market's experiencing a recession, we're talking about maybe 20, 30, 40% drops in things. And we've seen that recently. The market's been terrible this year, Dan, as you know, but the housing market has not been like that. They don't follow each other linearly. So I think just having that knowledge and that equipping of knowing that the government is trying to cause things to slow down, and that once they get to that point, then they try to stimulate the economy again, which involves reducing those rates, which brings people back to purchasing with more confidence. That fear goes down. And so right now they're trying to create fear to slow things down, but then they want to create confidence. So let's talk about the wealth accumulator, because Dan, this is something for you and I that's really important. And we're talking about buying a house, getting into debt, but then ultimately we want all of you to be able to get out of debt, but also come into a situation where you're financially independent and secure. So
that's
ultimately talk about this a little bit, Dan.
Yeah, that's our goal, you guys, with every single one of our clients. We're not just here to do a mortgage for you or sell you a house. And I talk on this because I am 46. I got about 15 years on you, Zach, 13 years on you. And so I know we both subscribe to this, but I can tell you as a middle-aged man, I started subscribing to this idea of the wealth accumulator about 15, 16 years ago. And I can tell you it's the truth. It's the whole idea is that one day, all of us, I know, share the same goal. At some point, we'd like to retire. And we'd like to not retire at 80 or 75. I believe that retirement is not an age. Retirement is a number. And if you can control that number, that you're going to be in control of your destiny, your future, and ultimately your life, and enjoy it. And this is the formula that I have been taught and I have subscribed to for the last 15, 16 years. And I teach this and it works. I'm living proof of it. So number one, you need to own a home. Simultaneously, it's good to have an emergency fund. So number one and number two, there's arguments out there. Which one comes first, the chicken or the egg, whatever. You got to get in the game. You got to own a home, but also you need to have an emergency fund in case crud hits the fan, or when crud hits the fan. The hot water heater goes out, the washing machine goes out, you lose your job and you got to find a new one. An emergency fund is 3 months of your total expenses in a money market account so that you can weather a storm. Normally, it doesn't take you 3 months to find a new job. Okay. Normally, it doesn't take you $6,000, $7,000. all your appliances don't go out at one time. It's normally a $2,000 hot water heater or a $2,000 washing machine or dryer. Okay.
Mhm.
So 3 months of your total living expenses and reserves, own a home. Number
Yep.
3, we all have jobs because that's how we have to pay for our mortgage. If you have an employer, there's a really good chance that you have a 401k or you can contribute to a 401k.
Yep.
Max out your 401k. If you did that for 20 years at 19,500, because that's the max you can contribute, you'd have more than 2.4 million in your 401k. That's pretty darn close to enough to retire. That's just 20 years of contributing to that. Number 4, invest what's left over into the stock market. You can do that on your own using the S&P 500 index. And as you can see from this, the S&P 500 index, with the exception of a handful of times, has given great returns. And this is the index that financial planners compete against. And the good thing is you can do this on your own by downloading the Fidelity app or the E-Trade app. What's the other one that people use? Oh man, Vanguard. There's a bunch of different apps where you can go and you can just type in the S&P 500 index and put your money in and manage that on your own and get a return. So it's so important that the 4 aspects to wealth creation, it's so important that you at least understand that. And then in closing, you guys, the 6 main financial benefits of home ownership, and Zach and I will beat this until you get it. You're gonna hear us say this a lot. Number 1, every single month when you make your mortgage payment, you're paying down what you owe on that debt. That's called a forced savings account, because you're going to sell your home in 3 to 5 years for more than you bought it for. That's called appreciation, which is number 4. But number 2, every single year when you file your taxes, you get IRS refunds against the property taxes that you paid, the mortgage interest that you've paid, and the PMI that you've paid. So on average, a $500,000 home is going to give you back $7,000 or $8,000 in refunds every single year from the IRS. Number 3, tax advantage. Why don't you talk about that one, Zach?
Yeah, so when you're buying real estate, there's a couple different ways that you're tax advantage. And again, it applies a little differently to everybody's situations, but in general, when you're purchasing a primary residence and you live in it 2 out of the last 5 years, right? Occupy it for 2 years in a 5-year period, you're able to, if you're single, have a capital gains exemption of $250,000. And if you're married and filing jointly, up to $500,000. So there's an opportunity, if it's your primary residence and you sell your home, to be able to, if you've experienced these last few years, potentially make $300,000-$400,000 on your house when you sell it, and then not pay any capital gains on it. So that's ridiculous.
That's big.
But
Yeah.
if you're an investor and you have rental properties, they have what's called a 1031 exchange. And I don't want to get too much into that, but a 1031 exchange allows you to roll over the proceeds from your sale of your rental property into a like kind property that's of equal or greater value. So you can take that money that you made and essentially defer the tax payments on that. Eventually you have to pay the capital gains taxes, but you're able to roll that money in without being taxed now into that next investment and continue to roll it into other investments as you move it up until you decide to cash out. So it's a pretty sweet program for investors. So you have 2 different ways that you can be tax advantaged. And then Dan talked about the home appreciation here, number 4 being a key part of that. And that's how you see, again, the last few years have been ridiculous amounts of appreciation, nearing almost 50% in some cases, which is nuts, Dan.
Yeah.
To see that over a 2-year period. And then that leveraged investment. So historically, you think about investing and you don't want to be borrowing money to invest that you might lose. But in this situation, real estate is historically the one leveraged investment where you can put 5-10% down. And I'll share my own story. So my house that my family's in right now, we put 10% down on it and bought it for $540,000. So I put a little over 50,000 in, and the seller helped pay some closing costs. That $540,000 house is now worth $1.2 million in a little over 5 years. And I know I've paid some, made some updates, and I've paid some taxes and things, but I've also benefited in these other ways, right? Forced savings account, IRS tax refunds, tax advantage, all that stuff. When we look at the home appreciation, that house, that 50 $100,000 investment plus maybe another $50,000 of updates to my house has now become over $600,000+ if I sell my house. And that's ridiculous. And then Dan, the cash flow, you love talking about this piece, but you've got the rental property potential or even the house hacking opportunity, right?
Yeah, absolutely. Okay. The final finishing touch of the night. Like how, what's it like buying a home? You just learned. What's it like buying a home with us and having us help you manage the largest financial decision of your life? This is how we do it. A lot of people will say that we have clients for life. A lot of people will say, hey, we're going to take good care of you even after we close your transaction. Well, what Zach and I do, we built out a program called the Happy Homeowner Program. This is the Happy Homebuyer class. So what is a happy homeowner? A happy homeowner is always being informed and educated on the market and making sure that they're managing their investment and managing home ownership responsibility to the best of their abilities. So number one, we subscribe you. It's free. We pay for it to HomeBot. HomeBot every single month. Think of this as like an investment statement from a financial planner. Let's say you have $1 million with a financial planner. Every single month you get a statement. Did that $1 million go up or did it go down? Did they make any trades? What happened with that account? Okay. HomeBot is a financial statement for your home. And it doesn't go off of like Zillow, the Zestimate or Redfin numbers. You actually help program HomeBot, what you paid for the house, how much you paid for it, when you bought it, any improvements you did to it, things that the normal algorithm online wouldn't know. And so you help basically appraise your house for you and have that financial statement every single month coming to you. Number two, we buy a House Happy membership. Think of this as a user manual for home ownership. So when you buy a car, your parents or your grandparents or someone might say, hey, every 5,000 miles, you need to go take it in and get an oil change. And then the oil change company will say, or the dealership will say, hey, every 50,000 miles, you need to do X. Well, House Happy does the same thing. It gives you twice a month prompts if you use their app or emails or texts on what you should be doing that month to take better care of your home. Now, let's say, for example, you need to build a fence. You got a new dog. You need to build a fence. You can literally ask for a quote or a bid from a House Happy licensed, bonded, approved contractor and get a quote sent right to you because your house is a part of their program. There's so many really amazing features to House Happy. You can order appliances online and have them shipped from the convenience of your phone. So when you buy a house, they do a 300-point inspection for you on the house. They identify all the types of appliances, the measurements for everything. And so if something does go bad or go wrong, you can go through the app. And again, they vet all these people and these vendors to make sure you're getting a good deal and that the installation is done right. And then they back it as well, all from the convenience of your computer or your phone. And then what Zach and I do is we do annual mortgage and real estate reviews. Every single week, I do a making sense of the markets video. It's a 4-minute video on something that has to do with mortgage, market, your money, and then something about your mindset. Because I'm a real big believer that in order to master your money and to master your real estate and your mortgage, you got to have a healthy mind. And it's important to feed your mind good things. And so I touch 30 seconds about mindset on those. And then Zach and I both, like we said earlier, really big on YouTube, creating content that really just help you navigate through your journey of home ownership successfully. So that's it. We encourage you all to subscribe to both of our YouTube and Instagram accounts if you want more valuable information. But other than that, if you have any questions, like this is where we take time. If you have any questions, I'm going to actually stop sharing the screen so I can see if there are any questions in chat. And if there aren't, or we'll wait around for a moment or two to see if you guys do have any questions. There's a couple that came in online and I'll go back and actually pull this up.
Dan, while you're pulling those up, Dan, I mean, if you guys are needing to jump off, this would be, that appropriate time. And before you do, or as you do, we just want to remind you about that strategy session. And if you got a lot of value out of this, it costs you nothing and there's no obligation to meet with us on Zoom or even in person if you'd prefer to talk through your individual situation. So if you got a lot of value out of tonight, please consider signing up for one of those or reaching out to us after the class and letting us know you'd be interested. And Dan and I would be happy to set that up for you.
Yeah. Hey, and we'll send you an email after this class tonight with a link to sign up for a strategy session. We'll send you our Calendly invite. So you pick the time, and then we'll set up the 30-minute Zoom block, or coffee. If you want to meet up for coffee, we're game for that too. Online, we answered this actually in the class. Online, how do you help clients compete when they only have 5% down? It's Zach's A buyer program. If you follow that to a T, we help Zach. You help clients get into homes with 5% down in a competitive market. Yeah.
Yep.
Are you worried about inflation or recession talks? Again, showed slides on that. I personally am not. I think it's going to present a great opportunity for you guys as home buyers. Will home values drop because of inflation and high interest rates? Zach talked about it. There may be a slight pullback, but we don't believe that home values will actually drop. There will just be a decrease in appreciation, but that shouldn't cause. There's a difference between like price reductions and a decrease in appreciation and home values dropping or home values being reduced. So I think those were answered.
And Dan, you were showing on those graphs. I think the graphs show really well when you have inflation and you have higher rates, you have temporary stalls, and then you have everything take off again. And it doesn't just go back to where it was. It continues to go because now there's more money in the economy. And the $500,000 house is no longer, that $500,000 isn't worth as much as it was in the past. And now that would be the equivalent of $600,000. So, as inflation continues, that we're going to see prices continue to inflate too for homes, just like that consumer goods are getting hit pretty hard right now this year. So.
I think you crushed it, man. I think this was a good class. I don't see any other questions. So I think we're going to wrap it up. We'll send an email to all of you guys with a link to the strategy sessions. And obviously you have our contact info. If you have any questions on any of this stuff, please reach out. But it was great seeing you all. Great seeing you again, Zach. And we have a live class this month on the 30th, Thursday, the 30th at Elliott Bay Brewing Company. So if you want to attend a live class and enjoy a drink and some appetizers with us, you want to share this with friends or coworkers or family members, we would love to see you. You can register, you can RSVP at happyhomebuyerclass.com. But other than that, I think we're good to go. Let's get out of here.
Let's get out of here. Don, I still see you're on here. Thanks for joining us today.
All right. Thank you, Zach. And thank you, Dan. This is very informative. And yes, I think I would like to learn some more.
I love it. Well, we'll send you an email for you to sign up. And we look forward to meeting up with you, Don, okay?
All right, sounds good.
All right. Good night, you guys.
Have a good night.